Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Josh Collinsworth, the portfolio manager at Nomadic Value Partners. Josh started Nomadic in 2019 after spending a number of years as an allocator. Josh is one of the most eclectic investors I know, and his understanding of the Byzantine U.S. healthcare system makes him my go-to investor when trying to navigate investments in that industry. In this enlightening conversation, we discussed Josh's path from being an allocator to starting his own investment firm, how he developed an expertise within healthcare, Nomadic's time horizon and how it compares to that of other investors, and portfolio concentration and position sizing. Now, without any further ado, here's my conversation with Josh Collinsworth of Nomadic Value Partners. Josh, you left a role at West Virginia University to start Nomadic Partners in 2019. I'd love to hear about the founding story and what made you decide to do something very entrepreneurial.
Yeah, it's been an evolution. I guess I should start with the long story of my childhood, which is pretty important with choosing to do my own venture. But my family, I grew up farming. So my father actually left a job to start his own farm, which is kind of impossible today, given the economics of it. But he started with one, and as I was growing up, I was very active in the growth of that venture into multiple farms. And when I turned 18, I went to college, and I did not want to just study. I wanted to do my own business. Actually, at 18, I took all my savings and bought a vending business that I ran for a couple of years. And actually, I had some space on the machines. I had the idea to sell advertising on them, all this kind of stuff I was trying. And that didn't pay my way through school, but it was certainly some spending money and some lessons and just, getting out there and hustling and talking to other business owners and trying to get my, a machines placed and whatnot. Also across that time, I was active in picking my own stocks. I've always been interested in the public markets, and I just, from middle America, growing up in an agricultural community, it's hard to have any kind of, belief that you'd ever be in New York doing something like that. But I enjoyed it, and I made a lot of mistakes at a young age with stocks, but anyways, there was that. And then when I actually dropped out of school 2 years in and joined a renewable energy a development startup, basically. And that didn't go as planned and ended up learning a lot. But, that was a venture that didn't work out. And I re-enrolled in school, and at the same time ended up getting a job in the city that I was going to school in with a development firm in renewable energy. And I worked as a project manager for about 5 years during and after school. We built a lot of solar throughout the Southeast. And this is a long story, but I'm getting to the point. Towards the end of that renewable energy experience, there was a what I call a concentrated family office. It was a multifamily office that most of the clients were siblings, but they all had their separate pools of capital, and is a multi-generational wealth and business builders from the Southeast. But I joined that as an analyst, and it just so happened that firm was based in the small town in which I went to high school in. And I knew that they were doing real investing. They were traveling to New York, Boston, London all the time, and specifically focused on emerging managers, and had a bias towards fundamental long only. And so I spent about 5 years, it's a little bit shy of 5 years, with that group, really, like cutting my teeth and learning what good allocation is, right? And finding a good firm that's usually in an upstart setting, but that's really getting started correctly on good footing. And it really does show up in outperformance if you do it right. So like that was a really good experience. And then that experience was furthered by, I had this view that I wanted to maybe be a CIO of some endowment or foundation or some kind of large pool of capital. And I was fortunate enough to get an opportunity to work for a university endowment, focused on emerging managers, but in private equity in a space that I hadn't spent as much time in. And it was across that time, and this is all in my 20s, right? So like in your late 20s, everyone goes through some kind of quarter life career, not going to say crisis, but like some kind of reflection of like, is this what I want to do? And I had such a wide breadth of knowledge around like different ways to make money, right? And then different networks and circles of investors in those different strategies and approaches, that across that time in my own personal account, I had proven to myself that I both enjoyed and was good at picking stocks. So it was just kind of like learning about, I enjoy kind of being on the front lines. So like, like right now as an allocator, I'm like, on the staff or like in the office of the 5-star general, and I really want to be the guy on the front lines. And that was a big realization moment. And just, I've learned to describe it better over time. It's just like, I like to have, like, I'm more motivated by having a greater pulse on the risk being taken. And I don't know if there's a book, it's on my bookshelf over there. I can't remember the name. It's like Strengths and Weaknesses or something. I can't remember the author of it, but I read that a few years ago, and it's really interesting how in some settings, someone's strengths can actually be weaknesses or headwinds. And then if you completely change the setting, that same person, same personality, same working style, same approach to life, all these things can be like outstanding strengths. And I think it's in your 20s, you should figure that out as a person, what that setting should be. It was becoming clear to me that picking stocks and running some kind of strategy was something that I needed to do. But the big question was, there was two big questions. One was, could I raise any money? I don't, I'm from middle America, not particularly wealthy, a network. And it's just like, I've built some connections, but it's like, am I going to be able to convince someone who sees that I don't have the pedigree from working in sell side, the target school, and then switching to buy side and working at the choice firm and all that stuff. I don't have that. Right. So like, it's, could I raise money? And then the second thing, which is actually something that I would say that I've crossed that bridge at this point, but getting started, and I think every emerging manager, whether they admit it or not. They have this issue, and that's when you get started on your own, and you either get a reduction in resources that you're used to, or an expansion of universe. And so across my personal account experience, there'd be times, more often than not, I'd have only 3 or 4 stocks. And there would be a period of weeks that I didn't look at the account. You can't do that for other people. Like you might could over time, 3 or 4 stocks in a portfolio, if that's, if you build your client base that way and that's your approach. But you got to look at your stocks every day, and it's like, you got to find a way to get into that flow. And so that was a question mark for me getting started. Was there was 2 question marks. So they're raising money, and then the am I going to be able to take this idea and really execute it? And so I chose the absolute best time to get started, which was March 2nd, 2020. So the very first month is down, it's okay, is this experiment going to work? But it's definitely, it has evolved so far past that now. I'm working on 4 years, and what hasn't changed is the approach, and the strategy hasn't changed, and it's been bettered over time. But what has changed is that universe is built out. I've got a fully invested portfolio. Early in my track record, there's a lot of cash in those weightings, which is suppressed returns in some way that is regretful in some ways, right? When you look back, it's like, well, man, I should have been fully, but it's stuff like that, right? But you got to figure that stuff out over time, and I would say that those 2 questions had to get answered, and they've been answered at this point as I've survived over the last few years. But to drive the wanting to do my own thing, and I think some of this is to get back to your first question. I'm rambling on a little bit, but is I have a lot of my father in me, and he is a farmer to the core, and there's a bit of this self-determination and drive that I kind of want to do my own thing, and that's definitely influencing it. So that, I think a mix of all those things of wanting to do my own thing, wanting to pick stocks, not having the pedigree, and kind of having to go a different path, and then really just, it's just deep in me to tinker and want to be commercial, and throughout that process. So that, I'd say that was really what culminates what Nomadic Value Partners has, been launched around, if that makes sense.
That's incredible background, and we're going to go dive deeper into a bunch of different topics there. But you did say something about your allocation experience and how you learned what good allocation looked like. What have you learned, or what did you learn from those experiences that's can be applied when you're building your own investment firm?
Mm-hmm. Definitely pattern matching around the managers that tend to outperform. What do they do day to day? What do they not do, I guess, is more important. And definitely seeing a wide or a large amount of managers like that, so you have a pretty good perspective on what you should not be doing. Also, I think, and we'll get into this in a second with my approach and industries I follow and things like that. But in the asset management business, learning how decisions get made, and how and how that differs from an investment committee where it's by consensus, or there's a single decision maker, things like that. You learn how all types of firms do that, and how they manage that, and what works and what doesn't. And there is no only one rule, by the way, but it's all situational. But you kind of narrow in on a preference as an investor, what you tend to want to underwrite, or assess the risk of. And then let's see. And just this general understanding that there are a million ways to make money, and there is no right way. But one thing that is consistent across all the different ways of making money is you have to be consistent with it. And that means consistent through periods of underperformance, which happens to every strategy. And then just, being like humble towards that. I think that there's a lot of investors that it's like, this is the only way you make money, or like that, or that you don't do it this way, or like that. That's like that's just not the way to think about it. But I think too, also understanding all the different ways folks make money in public and private markets is when you're looking at a shareholder roster, and kind of you can get a sense of like you can more quickly back into a narrative as to why this investor owns a stock at this time, and when you kind of see how the monies get made across the varying strategies, I think that's helpful.
So before we dive into the strategy and philosophy a little deeper, I'm interested in the name you chose, Nomadic Partners. How does that name reflect the way you've chosen to invest?
Yeah. So it's Nomadic Value Partners is actually what I've got filed in the courthouse as a DBA. But it's very personal to me. I've struggled to answer this in the past, actually. But it's very personal to me, as in I like to through hike. And a through hike, we can get into it if you want to, but like it's a point to point. It's dozens of miles, preferably over 100. At one time, you're carrying everything on your back. You're wild camping, as they say in Europe, but you're backpacking essentially over very long distances. And that is it's core to humans, as a species. But then it's also my experience as getting better as a through hiker has been a constant state of evolution. So like not change. And I understand like the word nomadic can imply A, that I ripped it off from Nomad Investment Partnership, which is not true. B, that I trade a lot in the strategy, not true. Or change my mind a lot or whatever. But but no, it's more to reflect evolution. And so this constant state of like learning, but learning in a sense of like getting better and the efficiency around a certain skill or thing that you're doing, which in my case is either through hiking or investing. But like I think it's pretty symbolic of that, into one for the strategy. Also, just me personally, outside of through hiking, I've also moved around a lot. I've lived in a lot of different states, and so like that's another one, but more personal than investing.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. So my interactions with you, it became pretty clear quickly that you have an eclectic taste in stocks. How would you describe your approach and philosophy as it comes to security selection?
So I'd really say it stems from, my time as an allocator, and I've always been rooted in fundamentals in a business, like business minded, and like what makes a good business and what is not a good business. And one way to learn what's a good business is to work in a not good business. And I grew up in one of those. Agriculture is extremely tough, and it's about as in certain pockets of it, it's near perfectly competitive, that we learned in economics class, and what that means for the economics of the owner. But so there's all of that, like in just the way I think, but then also as my time as an allocator, really honing in on, I would say, a style. And it's not a style that you could put into a bucket of like, oh, your growth or value or something like that, but like a style of a type of situation I like to look for. And it really stems from what I call minority growth investing. And so, you can say, well, so in private equity, you have late stage VC, right? And I bucket that into two things. One would be like late stage VC, that is the groups like the T. Rowe Prices and the Fidelities coming in 18 months to 2 years before the company goes public. And that game is a political one to get access. If you want to boil it down to factors, it's a momentum strategy. A lot of allocators that I've met like really poo-poo on that strategy. I would say that I tend to not invest that way myself, but it can be eye-popping returns if you get the cycle right. So it's not without trying, if it suits your fancy. But really, there's a second part to late stage VC. And I more associate with this latter one, and that's really, and this ebbs and flows with market environments. We're coming out of a market environment where just about every venture capitalist or every private equity firm got over their skis with TAM, and are like the momentum, closet momentum in investing in private markets. But you have these, it ebbs and flows, and a good growth equity, a minority stake. So you're coming into a private company and you're not buying a majority control and controlling the board and wiping clean management. That's not the approach. It's a company that's in place that you already like, that you take a minority stake in at an earlier stage. So that over the years, it's being increasingly Series B. So you have like seed stage, got Series A's, Series B through Series whatever letter you want to put before they go public. But increasingly it's Series B. And what that means to me, and I'm going to wrap into the approach here in a second. This is more of the definition of things that kind of like helps codify my approach a little bit, but is you're really underwriting two or three things as a minority growth investor. The first is it is the total addressable market, and I'm here to tell you your total addressable market is not $1 trillion. And that's part of the ebb and flow of the Silicon Valley drum, of the flow of that river, if you say it that way. But like, is like, what actually are we addressing here? What are we attacking? What's the size of the market? That we're in a period now where that calculation is becoming a lot more rational, and it should be. But a good investor is going to try to maintain rationality through those different market environments on that calculation. So A is like understanding an industry enough that you can have some idea of what kind of market and pain point you can attack and what that means in dollars, So there's that. That's part of the job. The other part is, America's been around now for greater than 200 years, and there's been a lot of consolidation of industries, and there are incumbents in these industries that are big and have a lot of market power. They're not going anywhere. This whole disruption thing, this whole like innovators a dilemma or whatever, right? I mean, it's like it's there, but it's not like the myopic view that a lot of folks have, right? I mean, it's like over time, market share gets chipped away by a better mousetrap, right? And so part of your job as a growth equity investor is to understand and invest behind what I call business model innovation. Mm-hmm. And that is specific to the situation you're in, the industry you're in, the company you're attacking. That innovation can mean various things, but basically you want to be in a preferred competitive position relative to the incumbency, right? And your due diligence should reveal that. And then the third thing is what I call having actual sponsorship in the company. And so in minority growth investing on the private side, you have that generally if you have a relatively focused capital stack and who's on it, right? And you have a lead investor, right? You have an investor in the round that is underwriting the deal, that's bringing in a small syndicate if needed, or if not. When I was an allocator, I preferred they didn't bring anyone else in. It was just one, but that's sponsorship. And that comes out of like decades ago in merchant banking, right? Where like the risk of loss is on the balance sheet of the bank, right? Mm-hmm. Like that helps a lot with making sure everyone's incentivized the right way, right? So you take those three big pillars right? And I apply those to my strat. Like it has like shaped the way I think about like investing and so like, but it's in public markets, right? So like, so I'm trying to understand the Nomadic Value Partners approach is trying to understand a small set of industries better than almost anyone else, right? I mean, it's like understand from the histories from the start to today, which people, because all industries have some kind of culture to them that were started by the founders that made waves in that industry and started what is now the incumbency, and how that's evolved over time. That learning about the assets at play in that industry, like what's the actual function of the industry, like what kind of resources are being used for this industry to do a thing, to solve a problem, to meet a need. Like those are like basic things that I think as generalists sometimes you can just miss because you're too focused on valuation of a company or what this person thinks about it or whatever. And like so like I try to keep focused on a handful of industries that I know really, really well. And what I mean more specifically by that is like having a network of operators that you can talk to on the phone, right? And that's not just through expert networks. I use those, but like it's like actually building relationships with operators, right? It's actually building relationships with private equity firms that invest in that space as a specialist. It's talking with other public equity managers that invest in that space over, I'm not that old, longer than me, right? And then also allocators who invest in managers across that or are more direct with their investing. So like I approach like idea sourcing, I guess, through that lens. And then really I call it the preferred asset to own. So an asset, which in the public equity strategy is a stock, but it really bubbles up. It really shows itself over, if you've done enough work, it's pretty obvious the company you need to own. It's just, does the valuation make sense? Oftentimes it doesn't. And so like you do all this work and you track and you can't own it yet. But it's that ongoing maintenance work that allows you to move quickly and aggressively when the valuation makes sense. And I guess in my approach too, and I guess you can cut me off if I'm meandering around, but like it all has to get distilled down into a set of metrics that I track as KPIs basically. And I look for opportunities ideally where the revenue growth, the drivers of the equity return, which would be, revenue growth, margin enhancements, capital structure changes, and like the returns, like dividends or buybacks or something, and change in valuation. I try to preferably keep that like ideally balanced, like equally balanced in a single stock idea, right? But you can't get that every time. You really can't get that most of the time. You're taking a bet somewhere in those drivers, right? And what I try to make up for that, and this is portfolio management, but I try to keep that balanced across the entire portfolio as a consolidated conglomerate, if you will, right? It's like it kind of addresses, I say kind of because it's like loosely associated. It's proven to me it's not perfect, but it kind of addresses the factor risk because because really what you're getting at is like duration and like keeping it kind of balanced in a way where a year like 2022 doesn't completely blow you up, or and it worked for me in that year, which I'm very thankful for. But like that's all those views and all that research and everything gets distilled down into a portfolio expressed like that. And then I'm concentrated because I want to move the needle, and this is I got all my own money in this. The same with clients, and I want to compound capital. And so like I don't want 30 stocks, and I've done a ton of work on these things and generally know them pretty well, isn't, relative to Wall Street. And so I want to capitalize on the information I have, the perspective, which I would separate from information, but just the general perspective, and trust my numbers, and really go for a forward IRR that is attractive.
And what does that look like in terms of concentration?
I own 10 stocks today.
And is that like equally weighted? How do you weight those 10 different positions?
It's not equally weighted, but there's three different sizing buckets that I kind of use as like a rule of thumb, and that's 3% slugs are very small. That would be considered a farm team for me. I understand that's big for some folks, but that's considered a farm team for me. And those might be in industries that I don't know as well, but that I'm working really hard to understand on the same, or I see a trajectory that I can get to the same knowledge level. And the opportunity for the multiple on invested capital is high, or there might be the industry is evolving maybe faster than I can wrap my head around, but it's still attractive. But that induces, or that like increases risk in my mind. And then also if it's in an industry where like so many factors out of management control, like any kind of macro thing can just like completely just blow up your thesis or something. And I try not to size over 3% that way. But then also, I've got like a 6% kind of sizing heuristic, which is the next level up, and then a 12% at cost. These are all at cost, and I let things drift. And I let stuff drift a lot. Like there's been multiple times now since I've started where a single stock has been 20% or more of the portfolio through drift. And that's okay. But it obviously increases risk if the valuation's gone up. If the big driver of it going up is because of valuation, and that you have to be mindful of that stuff. It's portfolio management. But and then I would say too that this is an evolution over time. As I used to, when I felt convicted in something, in an industry that I knew, and the tailwinds were there, and the management team was good, and the IRR penciled out really great, I would just buy a 12% position. I don't do that anymore. I come in, I really view a 12% position as well as a 6% position as a series of 3% trigger pulls. So I come in at 3, I'll build it to 6, I'll build it to 9, I'll build it to 12, and then and that's over a period of months. And really, I've got this little catchphrase that I use for myself, that it's thesis confirmed, over that as soon as like over a couple of quarters of owning it, that it's really tracking the way that I think it's going to fundamentally. And then the second part of that is trading experience earned. So thesis confirmed, trading experience earned, and that's just time. And so I've learned to really, that like reduces risk of my own execution by sizing the slugs like that.
And I would assume that if you're taking that big positions, your ideal is to hold these things for a while. So as I was looking through your materials, I saw an interesting chart that describes the nomadic sweet spot in terms of time horizon. Can you describe where that sits relative to that of other firms, such as private equity firms or family office?
Yeah, so that slide, I think it highlights like hedge funds, being one, and this is like a slide of expanding time horizon. So like from between 1 and 10 years. And so like you could think of that as duration of holding or something, but like, so like long short hedge funds, and I think private equity funds is next. And then, like family capital or something like, like dynastic family capital, like truly multi-generational. And then like it has those like investor subcategories, but then also like what drives the returns over over the different time frames, right? So like long short funds being 3 months to a year of holding, they're all going to say 18 months to 3 years. Most long short hedge funds don't hold that long. But what drives that? The sentiment change, right? I mean, it's like valuation changes. They're catching whether, and depending on the actual approach they're using, it could be relative value in a single industry. It could be relative value to the S&P, whatever. But like it's, or like informational advantages or special situations or something where it's like the market's got this wrong and it needs to re-rate. And sometimes I go down there. Sometimes if I like really know something and I'm confident in it and I think there's a re-rate opportunity, I'll go down there. But I'm not building a whole portfolio out of that. The next one, private equity. Everyone says private equity is like it's like locked up capital, 10 plus years, and it is like the actual for the LP's experience. It's like try 12 plus years, but the actual duration of the individual investments being made and what the GP, the general partner, is actually investing for in private equity is really, like 1.5, so 18 months to 5 years max, right? Because if you think about the fund, like the like lifetime, the way the cash flow of a fund is like, you're staging investments as you find them, and you want to wrap this whole thing up in 10 years. You can't buy a bunch of companies that you plan to hold for 10 years, right? So it's really there's some of that multiple re-rate that private equity, and I'm sort of overgeneralizing on that slide because it's not just private equity. There's a lot that goes into private equity, right? All the different strategies, but generally a multiple re-rate from some kind of like buy and build and like stacking companies together and getting scale, or some kind of multiple re-rate from just like long sustained organic growth rates from whatever advantage company has or whatever. So like that multiple re-rate is like deeply embedded in the return expectation of private equity, over that short duration. And then, the family dynastic capital I put that there isn't just really the word dynastic and the word family, meaning that like you don't really have constraints and you think multi-generationally. And that's finding companies, like what matters when you hold a company for 10 years and you want to outperform, like what is actually driving that? Well, it's returns on invested capital, but more specifically, it's the returns on the incremental invested capital, right? It's the direction of that. And which drives a re-rating in a lot of cases, but like also just the math of a balance sheet. If you're investing at high incremental rates, higher than the past, that balance sheet's going to recreate itself in really exciting ways over time, right? So like you're really investing for that, and that's the effects of compounding. So like that's driving it, and then if you look out farther than that, which I think is almost impossible, to be honest. But some firms have done it. Is company culture, right? And you could argue company culture is spread it around all that. It is. It's like every day, so everyone shows up to work is the short term, a series of short terms that build up to that long term. But then culture is important to that. But like those really long sustained outperformance periods, if you don't have that, then you're not going to have the long sustained outperformance periods, unless you just got everybody held at like the entire globe held hostage via your business model, like Visa or MasterCard or something. I don't know. But like, that's really what's driving those slides. And where Nomadic fits, I guess, to finish that, because I think it's part of your question, where Nomadic fits in that is sometimes I go down to the sentiment change, like I already mentioned, but most of the time it's that kind of it straddles that private equity period where you try to time the cycle right, which will generally drive some kind of re-rate over time if you're good and focused on the right things. And then if like me as an analyst is focused on the right things, I'm always shooting for a company that can be held for, over those return on incremental invested capitals and company culture periods. That's just not always the case. It's just the reality is it's really hard to predict 5+ years out and get all those things right on the front end. So, that's part of the beauty of public markets is you can buy and sell and you can move on. And but I'm shooting for that, right? So like I put Nomadic Value Partners on that slide. I straddle the private equity and the return on incremental invested capital. To be honest, I can't remember if I cross over into the culture one or not, but it's somewhere in there. Yeah.
And given that desired holding period and the difficulty of predicting growth, as you said, 5 years out, how have you typically approached valuing these companies? Is it a DCF? Are you looking at multiples analysis? How do you gain that conviction that there's a margin of safety, especially given that time horizon?
I almost never do a DCF. I think I've done a DCF one time on a forest product company, uh, um, for a sanity check. But like, it's almost always a build up, like some kind of analysis of what's building up my forward IRR assumption. And at the end of some analysis period, which is generally 5 years out, and it depends on the situation, but it's generally 5 years out. I want to make sure that when I take into account what I believe to be accurate assumptions, that if this equity trades at a market multiple, what's my exposure there? And that's really how I think about it. It's not much more complex than that. But I mean, I'm building models to calculate what true free cash flow is, right? I mean, it's like that's what I'm using to figure value. It's rooted in free cash flow, but it's some kind of market multiple is like on that out year is trying to see how I'm exposed on either over or under that. Understanding that moves around, but part of that is just this might be a slight change of subject, but I think it's sort of related. Is just like when you're concentrated and long only, like you should embrace the beta. Like and that's you're beta exposed, right? If you're looking 5 years out and trying to like see what you are over or under S&P multiple, but like knowing that S&P multiple could move around, and so will your multiple on your stock, right? But if you're looking at the right companies with real advantages, generating real cash flows, 5+ years out, and you're focused on the right levers and the right magnitude of those levers, that multiple change, unless you're getting way over your skis and buying something 50 times earnings or something silly like that, that risk is relatively minimal.
I think it'd be helpful to speak or chat through an example to kind of highlight all of these frameworks and philosophies that we've talked about. When we first met, we talked about this company called Oak Street Health. I may have the timing wrong, but it felt like right after we talked, CVS bought Oak Street for what I recall was a pretty healthy premium. As an example, I'm interested in what you saw in Oak Street that others might have missed.
Yeah. That one is fun to talk about because it's not in the portfolio anymore because CVS took it out. I can happily talk about it. And something, actually, we didn't talk about this, but I really don't want to talk about holdings that I currently own at all. But I'm happy to talk about anything in the past. And so this is one of those. I owned it in the past, don't own it anymore. But basically, healthcare services is an industry that I would say that I know really well, and I have a deep network of GPs and a network of operators at this point, and I'm constantly building that out and keeping a pulse on what's going on it's like a subsector. To say it's a single industry is a bit too broad, but it's like a subsector of general healthcare, right? And the thing is, what I like, actually, I should step. I don't want to go too much on a tangent, but it's important. It's something when I was in renewable energy, at a young age, was something that really shaped how my willingness to interact with industries that have high government intervention. So one thing that was burned into me as an experience and a very positive view of the government, which most people don't have, is when I was in solar, at the time, there was this thing called the Sunshot program that was it was drafted, it was implemented and administered by the Department of Energy, and with crossover with the National Renewable Energy Lab. And what it was the U.S. government knew that we needed to decarbonize, and they didn't say that term back then. This was middle 2000s, 2005, 6, 7, actually George W. Bush. But the goal was, hey, we need to build more renewable energy. We need to upgrade this grid. And we don't have the supply chain to do it. And it's kind of a chicken and egg problem. So the government stepped in and came up with a program that had many moving parts. But basically, the goal was like the ultimate goal. It had many moving parts, but they had one goal, and that was to get the cost to install utility grade solar to below $1 a watt. And that reasoning was there because, or that goal was there because that is what got the levelized cost of energy over a lifetime of a solar project to being below the cost of everything else, right? And it was self-sustaining. So to do that, you had to build out a supply chain, and the supply chain wasn't there. And so they created all kinds of programs to enhance that, and it worked, and it crossed multiple political parties, right? It was Republican to Democrat, back to Republican, and back to Democrat. Since it was enacted, and it worked. Solar's below. A utility scale solar can be installed for sub $1, and it is the cheapest, depending on what market you're in. Most markets it's the cheapest. Some markets like Texas, sometimes wind produces at a negative rate, but and it's way cheaper than nuclear. Sorry, nuclear bulls. Your levelized cost of energy is expensive. Like I'm not poo-pooing on your technology and the fact that we might need it, but it's just more expensive. And so like so it worked. So let's shift it back to healthcare. Healthcare, I think I'm going to make a call here, and I could be wrong, but I'm tracking right currently. Is I really think healthcare's like public sentiment, like peak negativity, was at the passing of the Affordable Care Act. And it might be a window of 2 years at the election of Trump. So like the Affordable Care Act was passed in like 2010, enacted like 2012 or something, and then like 2014 to 16, that period, like when all the drama around the health exchanges and the costs and everyone kind of like exiting it and all this stuff. That's probably the peak negative sentiment from the public with the U.S. healthcare system. And the reason is the Affordable Care Act was actually a really great piece of legislation. It definitely had its problems, but the point of American democracy or representative republic, whatever we are, is we pass legislation and then we go back and we tweak it, right? And because like something doesn't work, or like something that was unforeseen came out and it was bad and we need to go change it. And that process has been working in healthcare really well, actually, more recently. And so like the ACA really set that in place because part of the ACA was they started a new innovation center called the Center for Medicare and Medicaid Services, the CMS, started this new innovation center called the CMMI, which is their innovation center. And in that, they had lots of industry collaboration between the government, payers, providers, pharmaceuticals, even we have an incentives problem in the healthcare system, right? It's like the fee-for-service throughput. You got all these power struggles between payers and and health, like hospital systems, and a lot of companies are borderline fraudulent, and like all just like big incentive problems. This innovation center really was set up to figure out how to fix those incentive problems, and it's working. They basically have been releasing program after program, usually within Medicare, but also in some state-run kind of managed Medicaid programs in collaboration with the feds, and where they have been basically coming into, the goal is to push the financial risk, which historically has been either paid by the government or by payers, closer to the provider, which incentivizes the provider to actually follow through with care and actually generate better outcomes. And over time, that actually shows up as like lower cost. And so that's actually working. And you're starting to see it proliferate across the country in various models and various subsectors of the delivery of care. And now increasingly so on the employer-sponsored market and different age cohorts and how that healthcare is delivered. So there was a group of companies, it's more than a group, but there's been a ton of companies at this point, but really in the beginning of those models that got started in what I call that petri dish of understanding how to like push risk closer to the actual patient. And they like figured out all the kinks, right? They worked out all the kinks, and they built business models that generate outcomes, have better patient satisfaction, save money to the healthcare system. And they're actually solving problems for not all these companies, but the one, Oak Street in particular is one of them, and there's a handful of others, but where they actually solve problems for every single stakeholder in the healthcare system, right? They solve problems for at the macro level, CMS and all the big payers, all the state-run programs within all the like United Healthcares and the Humanas and that are running Medicare Advantage programs that are being pushed and prodded by CMS via the regulation to just do better and across these a variety of metrics. Oak Street played to those, but then also the patients, like, it's undeniable the level of care and the increased outcomes, the better outcomes that came to the patient from a patient that was seeing an Oak Street doctor and was in Medicare Advantage plan or Medicare Shared Savings or ACO REACH, which is the new one, direct contracting, all those programs Oak Street was in and proved that their model generated savings and way better outcomes relative to their local benchmarks. And then the final thing that Oak Street solved was Oak Street was founded by a couple of guys who were consultants. They worked at BCG and their healthcare practice, and they really took seriously building a really, really quality culture. And it was undeniably better than everything else. Like it was like obvious. And like through my due diligence, like I actually, before all these provider groups are actually public, there's a handful of them public now. Before they were all public, I was studying this because I was learning about this transition into more, risk-based provider groups and all this. And Oak Street had bubbled up as the premier asset. And then when they filed their S1, it was a no-brainer for me to like really do the work. It just did not have, not even in the same ballpark against any competitor. And that proved over time too, as they went, they had General Atlantic as a private equity firm. It was a big sponsor, which I've have done a lot of studying into their past companies. They are like on the ball with this whole thing, and great sponsor. And so they had a lot of capital. But when they went public, they raised a lot of capital, and it was, in hindsight, at absolute market mania peak, right? At like a good valuation and low dilution. And they raised a boatload of capital. And part of that actually too was a convertible bond at a 0% coupon. And so like they had capital, and they went and started blitz scaling across the country, and so one concern would be, how in the world can you blitz scale? And one distinction with Oak Street is they early on chose to really emphasize, and actually, well, it's not just really emphasize, only emphasize organic growth. They don't acquire practices. Like they make acqui-hires sometimes, but they don't go buy provider groups to scale into a new market. They build it from scratch. And that was a complaint from Wall Street because it took longer than anyone wanted on Wall Street. But it was true organic growth, and they had built the engine that was required to sustain that organic growth. And I think everybody was missing that. And they were just seeing enormous losses. And part of flipping patients to risk in Medicare Advantage is there's a J curve per patient. Like it's like the unit economic of the patient. First couple 3 years, you don't make money on that patient. And then as you like literally address the sicknesses of this patient, which Oak Street focused on like the multi-chronic, generally poor, and like the social determinants of health, which is a phrase, they were very good at managing those patients, and they would see massive inflections of the, for the same revenue, but the health spend that they were taking on as risk would go way down because they would pretty much keep that patient healthy, for their age and for their longstanding problems. So that would accrue as in a margin to them. And so I think the street and other investors especially investors that aren't healthcare investors, but like they just miss that, and they were getting operating leverage. So like as they were growing, they were getting operating leverage where it mattered, which was in G&A and contracting rates on certain health spend. But they were still showing greater and greater losses because they were growing so fast. My big concern at that time was you're growing super fast. Surely your outcomes are going to slip, right? And then like the unit economics start to break at that point. They never slipped. It's pretty amazing. It was actually, it was fantastic, the performance that they were able to do at that growth rate in new markets, and completely different universe than all their competitors. And you can go and look at data on CMS. All this stuff's public. Like if you know where to look, you can go and look and see their outcome data on the different programs, the various programs that they're involved in. And they were in a completely different ball field than everyone else. And so like that was really important, right? I think the street was missing that. My mistake was I sized the position up too soon. I overpaid in hindsight. And I would say if we never did a big lift off on ZIRP, from ZIRP, and interest rates didn't swing as much as they did in 22, I'm not sure that it would have caused me as much pain as it did. And you say, well, you should have always known it. But we don't know what interest rates are going to do, right? It's like, but still, I think I managed the position well. Like it at one point, I think it was, and this is going to be eye popping and might push some prospective investors away, but like it went down 80% peak to trough, and I never sold any of it. I didn't buy any of it. It came pretty quickly. I got on board pretty quickly with the rise in interest rates, and this is kind of like going to change some things. And in hindsight, yeah, I should have sold it all and then bought it back. But the way I handled that was just not buy any until the storm passed. And then there was some, this is getting into the details of portfolio management and blocking and tackling. But basically there were some signals that were pretty blatantly obvious that I used to like size up the position at different times and gave me confidence to do so. But, there was multiple ways to analyze that company. It was, the big things that I just mentioned there that you had to get right, which is that culture showed up in better outcomes. It showed up in maintaining the growth rate, just or maintaining those attributes despite the growth rate. They also were very savvy capital allocators. I thought, they used the markets to their advantage. But you could have also, and actually, I got to know this group through this name, but there's a group called Route One Investment Company. They were big shareholders in it. I got to know their senior analyst there that covered that company, and he crossed over into retail, and the way he viewed that analysis was per box, right? Mm-hmm. So you build a facility, and it takes a certain amount of time to like staff it, and then that's all incorporated in some kind of IRR that the facility generates, or a net present value rather. And he like calculated it that way. And I like tried to get onto his perspective and like turn it around and evaluate it that way. And because I was evaluating it through like a per patient basis and just kind of trying to project out that J curve and like where that flows, and then the assumptions of like G&A leverage and things like that. But like, he was doing it on a per box and then calculating a net present value, and then was using that as like is this undervalued or not? And it traded multiple times at a discount to the net present value of the like stores that were in the ground already. not the ones that are going to build next year and the year after that, and the year after that. And it just was one more kind of like perspective to like add to the view that this thing is like not being valued appropriately. I think they ultimately got taken out by CVS because CVS wanted a primary care platform that their competitors were all getting, but B also saw the significant synergies that are out there when you have more control of the health spend across the entire value chain, from because they own Aetna, the big, in a big Medicare Advantage plan that has been struggling. They're getting better at it, and all the way down to the delivery of care. And actually, they just had an investor day here a couple weeks ago, maybe longer. I can't remember. 3 weeks ago, 2 weeks ago, something like that. And they had a slide in there, and their CFO was talking about it, and it was followed by Mike Picos, who's the former CEO of Oak Street, now kind of running their whole delivery segment. But that for like every 1% penetration of a patient or a customer that interacts at all with the CVS asset, whether that's walking into a CVS store and buying paint, like Advil or something, or using CVS minute clinics or CVS Caremark as their PBM through some other thing, some other relationship with a payer or something, or part of Aetna, like in their MA plans or something, or a patient of Oak Street. If someone that uses one of those, that engages with one of those assets, if they can get that patient to engage with all of those assets, they see, like, if they can just increase that engagement, and they measured it across like all the potentials, like as a 1% engagement across the whole enterprise, that's a $500 million operating margin enhancement. And that's pretty significant, right? Just a 1% move. And right now they're like a 0.5% of what they measure, if they can even measure that to that degree. I guess there's some margin of error there, but like, that is huge, right? And like Oak Street is like a very key asset for that on a very large item of spend in their Medicare Advantage plans. So like, I know several healthcare focused investors that are bearish on Oak Street. Think it's just incinerating money, and also it's like, man, you're not doing the work. Like I mean, seriously, like, understand what's happening here, and I don't care interest rates went to 5%. I mean, it's like this is not a ZERP phenomenon thing. This thing was incubated out of government regulation to fix a system that has a multi-decade transition, and they are solving problems for everyone in it. And it has a massive financial impact. Like, that is enormously valuable. And I kind of needed that stock to get sold like that to kind of have some proof points in my strategy. But man, they took that away from me. I wanted to own that stock for a long time because that was going to be $100 stock. I mean, I got taken out at like 39 or 38 or something, and we had averaged our cost basis down to like the high teens, low 20s, depending on the account. Like, I mean, that's a great cost basis. And that was my largest position going into the start of this year, which feels like forever ago. But it like, that was gonna be a $100 stock one day, and like yeah.
Well, I think that's such a good example because it really highlights so many different things you focus on: unit economics, culture, right? So I think that was a perfect way of encapsulating the Nomadic Value Partner strategy. This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. We can't ever leave a podcast without talking about the business of investment management and the client aspect. So one of the topics that shows up a lot in your presentation is the idea of limiting growth of assets and the number of clients. What is the philosophical underpinning there?
So when I started Nomadic, I had this like kind of like it was a phrase, but it was in like a joking manner, but also real. Was like, I don't want any client that I can't have a beer with. It's like, and I think what over time I've been able to like put more nuance behind that, of just generally like be on a like have a personal connection with a client in some shape or form, but then also open lines of communication. And over time that's evolved. And there's been a couple things that have really helped me understand where I want to take a stand on that and actually say that I want to limit growth. And if you don't mind, we could be running low on time, but like I've got a story that helps with that. It's actually about through hiking, but it was a really like cohesive thought I had, which I don't have very many cohesive thoughts that just hit, like it's like, it's usually very slow burns but like this was actually a thought that like popped into my head when I was on a through hike once. And I was in the Uinta range in Utah, and it's like exactly 100 miles, like east to west. And it's actually the longest east-west mountain range in North America. It's like the only east-west mountain range in North America. So like, I guess they can't, but like, only being 100 miles. But anyways, it was I like those distances because I can knock them out in 4 or 5 days. And that was a trip that I wanted to do in 2021. So I went on it, and that my evolution of through hiking has been one where it starts off with just like learning how to walk, of like, ow, my ankles hurt, or wow, I get shin splints. How can I maintain 20 miles a day? It's like, how do I like keep the fitness of that and then like learn my body? But then also over time, it's gotten into like, how do I maintain 20 plus miles a day over terrain that may be 3,000 to 5,000 feet of elevation change every day, or like, or like, how do I cut across like an open range of desert, right? Where there's like very little water, or like, how do I actually navigate where there's a zero trail at all? Right. And like, I want to get better at like moving faster over different terrains like that. Right. And so like when I do these walks, they're like a little bit of like like almost a spiritual, because like it like breaks me down physically. It's some kind of new skill that has some risk attached to it, should I not be able to do it. And I'm alone. And so there's a lot of thought about investing. And as I've started Nomadic, lots of thoughts about Nomadic. And so I was on this walk, and I was actually, this is an aside, but a quick one and a fun one and a lesson. But like, I usually use a GPS on my phone to tell me where to go when I go off trail. So this particular walk was 100 miles in total length. Half of it was on like actual trails. Quarter of it was on what you call a use trail, which is where a lot of people go on a peak or a pass, but there's no actual marked trail. So there's generally some markings, but it's sparse and few in between sometimes. And then the other quarter was completely off trail, just bushwhacking through, like cutting across something. And so I was about halfway through, and I had a creek crossing, which is actually a raging river. I messed that one up. Thought it was a creek. It was actually a raging river. And I get across it safely, and I look down and my phone's gone. And I was like, oh shit, I don't know where I'm going. And luckily, and this was the mistake, was I was actually packing really fast. It was after a business trip, and I wanted to jump on this trip, get it done, get back. And I packed a paper map, did not pack a compass. And so I had a paper map I'd studied the trail enough, luckily, before that or the path, that I knew the mix of trails and path that I needed, and the names of the passes, more importantly. So I ended up walking the rest of that walk with just a paper map and looking up and using geography as a handrail, you call it, where like you need to walk down the stream, and then after so long you cut, and there's this peak there, and then like this lake here, and like that kind of thing that kind of navigate through. But anyways, I was 1 day past that, 2 days past that. I was in the second day past that, and there was this pass called Dead Horse Pass. And the passes in the Uinta Range, well, there's two things unique about the Uinta Range. Is one, the passes don't really require any scrambling where you're on your like hands and knees over like big talus boulders and things like that, but they are steep as shit and like loose gravel, and they can be kind of treacherous, and they're like really narrow. And so like that's kind of fun. And then the second unique thing to the Uinta Range is they are super wet. Like it rains and storms all summer long. Like thunderstorms, like just rolling thunderstorms all day, all summer. And that's kind of dangerous when you're going over a pass, right? And so I was this particular day, it was like I can't remember the exact time of day, but it was like somewhere around midday. And I needed to go up and over Dead Horse Pass. And I was kind of tired. And if anyone does any kind of endurance, anything, it's like the body can go and go and go for a long time, but you got to keep it fueled, and in like very certain bits of rest. And I was kind of at the end of like I needed to eat something, but but anyways, there was a storm that was pounding up against this mountainside that was right beside a Dead Horse Pass, and which was kind of protecting the pass, but also at any point in time that storm would come over. And so anyways, I got over the pass. I took a risk and went over the pass, and sure enough, I turned around and look, and it's storming right on top of the pass. And I had this like really coherent thought at the time. I was like, if I was guiding 5 people, would I have done that? Right. And that I spent like the rest of the day that day just like thinking about that. And then I've spent lots of time since thinking about that. And then I recently read this book called The Model by Richard Lawrence. And he actually writes that they limit growth to like X% per year or something, which I've since learned is something he uses to evaluate banks. Like if they're growing faster than this X%, then they're not going to like. But anyways, it's written in his LPA, in his limited partnership agreement, that they're only going to grow so much per year. And he actually challenges other investors. He said publicly, write in your LPA to do that. And if you do that, and you come to me and want me to help you raise money, I'll help you, like kind of thing. And it's like, that's kind of like a really aggressive, like foot forward. It's like, do it, and no one does that. Right. So I don't have an LPA. I don't have a limited partnership, right? I do separately managed accounts, but like I take that in combination with like that thought of like, would I guide people over this? And like, there's that saying, you want to go fast, go alone. You want to go far, go with others. And I've just determined that I want to go fast and I want to go far. And so like, yeah, I would guide 5 people over a pass like that, but they got to be people that know what they're doing with the pack they're carrying and the distance they're walking and all that. So to wrap it back into investing, it's, and I had this on a slide in my presentation, and it is like, limit growth to investors that understand and like want the returns profile of concentrated value investing. And that, basically what that means is volatility, right? Like you understand what I'm doing and you will actually embrace the volatility, because that's when our behavior can get aligned correctly to generate outperformance on a money weighted basis. So that's really what I mean by that. And I'm going to stick to it. And, like if a potential client comes to me and they're like part of a fund to fund that's hot money chasing a track record, we're not going to do business, and like, that's my dedication to that, is like, and that benefits my clients, right? Like there's like, if you're managing money for other people, it can be a head spin when you think you're going to lose a client, right? And it can get you out of your game when you need to be focused on portfolio management or research or something, better serving current clients that aren't acting like that or giving you pressures like that. So like it's I'm dedicated to limiting growth, not necessarily to a number, although that it incorporates, but like but limiting growth to clients that really, really embrace the process. Sorry for that really long story, but it was actually really important to me coming up with that.
Yeah, no, what an interesting way to come up with a business philosophy. So I have a million more questions for you, but I think we're going to have to close with our favorite question and the one we asked all our managers, which is, what do you think is the most underappreciated aspect of the investment opportunity set that's in front of Nomadic Value Partners?
The investment opportunity set. I mean, I'm really trying to build the foundations of a business that's going to be here for decades. And it starts with the research process. It's been highly engineered into the operational procedures and choice of structure of how like the actual vehicle at which I manage others' money in. It's in the fee rate. It's in all, it's in these things. It's absolutely in the clients I select. So what that means in terms of the investment opportunity set is that I really seek to build that. Like I've already built some, but I'm only 33 years old, right? Like I've got decades in front of me to build an institutional knowledge set about industries. That's valuable, and that's going to show up in returns. It has shown up in returns, and I strongly believe that it will show up in returns.
Great. Well, Josh, you are one of the more unique thinkers of anyone I know in this space. And you have such an interesting background from farming to solar to allocator, to actually putting money to work on behalf of clients in stock portfolios. So we appreciate you sharing all of those wonderful anecdotes and stories. And thanks for being on Compounders.
Well, thank you so much for having me. I'm super grateful that you think I'm worthy enough of being on this podcast or interesting enough. But Ben, we've known each other now for, I guess, a year ish, something like that. But definitely have become a friend, and I really appreciate the choice times that we spent together and talked, and I'm looking forward to that in the future too. So
likewise, thanks, Josh.
Yeah, thanks, Ben.
Josh mentioned a number of securities on his podcast. I do not own any of them.